Hello, everyone, and welcome to another lecture on ratio analysis and interpretation of financial statement. Today, we are going to study another category of ratios, and that is investor ratios. Investor ratios are key metrics that provide a clear picture of the company's financial health from an investment point of view, focusing on profitability, market valuation, and income potential. These ratios are crucial for evaluating the attractiveness of a company as an investment option. They focus not on the day to day operations but on the broader financial outcomes that matter most to the shareholders. Investor ratios are designed to assess how well a company is performing in generating returns for its shareholders. These metrics help investors determine the potential profitability of investing in the company and analyze the risk associated with their investment. Unlike operational ratios that focus on internal efficiencies, investor ratios provide an external perspective indicating how the market values the company. They are crucial for making informed decisions regarding buying, holding, or selling the shares. And they also help us in understanding how well the company uses its resources to generate profit and value for their shareholders. Now, there are three key investor ratio that we are going to learn today. Number one, earning per share, or in short EPS. EPS measures the amount of net income earned per share of stock, indicating the profitability of the company on per share basis. Number two, price to earning ratio, or in short PE ratio. PE ratio assesses the market value of a stock relative to its earning, showing how much investors are willing to pay per dollar of earnings. And number three, dividend yield. It shows the percentage of the company's share price that is paid out in dividends each year, highlighting the income investors can expect from holding the stocks. Understanding these investor ratios is crucial for anyone looking to invest in a company, and we are going to cover each of them in greater detail. In short, these ratios ultimately influence an investor's perception of whether a company is suitable and profitable investment. All right, let's start with our first investor ratio, that is earnings per share. EPS is one of the most fundamental investor ratio as it measures how much profit is attributable to each outstanding shares of common stock. Think of it this way. When investors put their money into a company, they are essentially buying a fraction of its ownership. EPS helps them understand how much of the company's profit is assigned to each of these shares. This makes it a critical tool for investors as it provides a direct indication of the company's profitability on a per share basis. And this is essential for assessing the value of their investment. Now, to measure how much profit each ordinary share gets, we use the following formula. We take income attributable to ordinary shareholders in the numerator and divide it with the number of ordinary shares. Here, income attributable to ordinary shares is the net income of the company, that is profit after tax, less dividend on preferred shares or preferred stock. So basically, there are three components of this formula. First is net income, that is profit after tax. This is the total earnings of the company after all the expenses, including taxes and interest on debts, have been deducted. It represents the amount of profit that is available to all the shareholders. From the net income, we deduct preferred dividend. These are the dividends that are obligation towards the preferred shareholders and must be subtracted from the net income because preferred dividends are typically fixed and take preference over dividend to common or ordinary shareholders. The adjusted numerator, that is net income minus preferred dividend, indicates the profit available for ordinary shareholders after meeting the fixed obligation to the preferred shareholders. And then the third component is the number of ordinary shares. This is the total number of common shares that are outstanding during the period. For example, if a company earns $1 million in net income, pays $200,000 in preferred dividend, and has 400,000 ordinary shares outstanding, its EPS would be net income of $1 million minus preferred dividend of $200,000, and the differential is divided by 400,000 ordinary shares outstanding. This means that each share has earned $2 in profit over the reporting period. The final answer of EPS represents the earnings available to each ordinary shareholder. This EPS of $2 means that for each shares held, the company has earned $2 over the reporting period. Now that we understood the calculation, let's move on to why EPS matters so much to the investor. EPS directly reflects a company's profitability on a per share basis. A higher EPS suggests that a company is generating more earnings for each share, which is a positive sign for investor. Investors use EPS to compare profitability across companies in the same industry. If the company's EPS is significantly lower than the industry average, it may indicate underperformance, leading to concerns among the investors. On the other hand, a higher EPS is often seen as a sign of higher profitability per share, making the company more attractive to the investors. An EPS that meets or exceeds expectations can enhance investor confidence, supporting higher market valuation and shareholder loyalty. Also, EPS can significantly influence the market price of a share. Investors often use EPS to make buy or sell decisions, driven by the perceived profitability and future growth prospects of the company. A rising EPS can boost shareholder confidence, often leading to an increase in stock price. On the other hand, a falling EPS can signal trouble, causing investors to sell their shares, which may lead to declining stocks price. Since EPS is closely monitored by the investors, management often feels pressure to maintain or improve the EPS. If EPS is consistently low, shareholders may push for leadership changes or demand better strategies to enhance the profitability. In short, earning per share is a vital measure for investors because it provides a direct link between the company's profitability and the shareholders' value. It not only helps investors decide whether to buy, hold, or sell shares, but also serves as a key benchmark for evaluating the company's financial health and growth potential. However, EPS should never be analyzed in isolation. Investor must also consider other financial metrics such as revenue growth, profitability trend, industry comparison to get a complete picture of the company's financial performance. So, my friends, whenever you analyze a company's EPS, don't just look at the number. Ask yourself what's driving the change in EPS and what it means for the company's future. All right, my friends, let's move to the next part of our lecture on investor ratios. My friends, investors buy stocks with the expectation of earning return, either through dividend or capital appreciation. But the big question is, how do we know if a stock is worth its price? And for this purpose, one of the most widely used valuation tool is the price earning ratio, in short PE ratio. This ratio is a fundamental investor ratio that is used to evaluate how the market values a company's share relative to its earning. In simple terms, it answers the question how much investors are willing to pay for every dollar of earning that the company generates. The P ratio reflects market sentiment, investor expectations, and perceived future growth potential. A higher or lower P ratio does not inherently mean that the company is overvalued or undervalued. A high PE ratio means that investors have high expectation for future growth, whereas low PE ratio indicate that investors lack confidence in its future earnings potential. My friends, always remember PE must be analyzed in context with the industry norms, economic conditions, and the company's fundamentals. So now that we understand its importance, let's move on to how it is calculated. The formula for PE ratio is the share market price divided by earnings per share. In this formula, market share price is the current trading price of one share in the stock market, and earning per share is the company's net income attributable to ordinary shareholders divided by the total number of outstanding shares. The P ratio is expressed in times, meaning if a company has a P ratio of 10, it means investors are willing to pay $10 for every $1 of current earnings. It can also be interpreted in a way that the company would need to maintain the current level of earnings for the next 10 years to pay back to the investor the current share price. Of course, a high P ratio, let's say 10, does not mean that investors expect to wait for 10 years to recover their investment. Rather, they expect growth in profits. Imagine two companies, Company A and Company B, both operating in the same industry. Company A has an EPS of $2 and its shares is trading at $10 per share. Its P ratio is $10 divided by $2, that is 5 times. This means that investors are willing to pay $5 for every $1 of earnings. And Company B has the same EPS of $2, but its shares are trading at $4 per share. Its P ratio is $4 divided by $2, that is 2 times. Investors are only willing to pay $2 for every $1 of earnings, suggesting lower confidence in the company's future growth. Now that we know how to calculate the P ratio, let's explore how to interpret it. The P ratio can tell us a lot about the investor's sentiment, company's valuation, and the expected growth prospects. If P ratio is greater than 1, this indicates that investors are paying more than a dollar for every dollar of the current earnings. This suggests investors' confidence about the company's future growth. A high P/E ratio could indicate that investors believe that the company will generate higher future earnings. But a high P/E ratio can also mean that the stock is overvalued, making it risky if future earning disappoints. If P/E ratio is equal to 1, it means the market values the stock exactly in line with its current earnings. This suggests investors believe that the company is fairly valued with neither high growth expectation nor major risk. If P ratio is less than 1, this means investors are not willing to pay $1 for each $1 of earnings. This indicates that the market values the company at less than at its current earning. This could be due to lack of confidence from the investors who may be concerned about the declining future earnings or other company risk. Well, despite this interpretation, P ratio must always be analyzed in context with the industry norms, economic conditions, and the company's fundamentals. For example, Comparing a company's P ratio with industry average or direct competitors provides a benchmark and deeper insight into its relative market position. Like a technology stock often have higher P ratio due to high growth expectations, whereas utility companies typically have lower PE ratio since their earnings are stable and not rapidly growing. A P ratio of 20 may be normal for a tech company, but very high for a manufacturing company. In summary, P ratio is a powerful tool for evaluating market perception and investor confidence in a company. It guides investment decisions by comparing stocks within the same industries. However, P ratio should never be used in isolation. Investor must also consider growth rates, industry trends, financial health, and market condition to make the informed decision. All right, my friends, let's move to the next part of our lecture on investor ratio. When investor buys stock, they see two type of return. One is capital gain, that is when the share price increases, they will sell the shares for a profit. And number two, dividend income, that is distribution of a portion of profit of a company to its shareholders. If you are an investor focused on income generation, you need to know how much dividend income will I earn? Is this stock a good investment for passive income? Does the company have a stable dividend policy? And to answer these questions, we have a key investor ratio, that is dividend yield. Dividend yield helps measure the return a shareholders gets from dividend relative to the share price of the stock. It offers insight into the effectiveness of the investment from the dividend income perspective. Let's first understand how to calculate dividend yield and then we will explore it further. The formula for dividend yield is dividend per share divided by market price per share and multiplied by 100. This formula provides the percentage return that investors earn from dividend for each dollar invested in the company's stock. Let's take an example to bring this concept to life. Suppose a company's share price is $10 per share and it pays $2 dividend per share annually. Dividend yield is $2 divided by $10 and multiplied by 100. The dividend yield would be 20%. This means for every $10 invested in the company's stock, the investor receives $2 in dividend. Effectively, investors are receiving a 20% return on their investment in the form of dividends. All right, my friends. Dividend yield fluctuates on the basis of key factors. Number one, the amount of dividend, and number two, the market share price. If the dividend increases while the share price remains stable, the dividend yield will increase, showing a higher return to the shareholders. And if the dividend decreases, the dividend yield will decrease, making the share less attractive to investors. Also, if the share price increases while the dividend remains constant, the dividend yield will decrease as the return relative to the investment becomes smaller. And if the share price falls but the dividend remains the same, the dividend yield will increase. Now that we understand the mechanics of dividend yield, let's discuss its strategic importance. Dividend paying stocks attract income focused investors such as retirees or conservative investors. Companies that maintain or increase dividend consistently tend to have strong financial stability, while companies that suspend or cut dividend, this often signals financial distress. Changes in stock price influenced by external factors like market trends or economic conditions can affect the dividend yield. Generally, in bear market, investors preferred high dividend stock as they offer stable income. Whereas in bull market, investor might favor growth stock with low or no dividend because they expect higher capital gains. While a high dividend yield seems attractive, it comes with risk. It's crucial to assess whether the company can sustain such payouts without compromising its financial health. Investors should consider both dividend yield and potential capital gains. A lower dividend yield might be offset by higher capital gain if the share price increases substantially. For example, if a stock price rises from $10 to $50 while still paying a dividend of $5, in this case, the dividend yield falls from 50% to 10%, but there is a higher capital gain of $40. In summary, dividend yield is a crucial ratio for investors seeking regular income from stocks. It helps investors understand how much they are earning from their investments in terms of dividend. A high yield is not always good. Investors must also check dividend sustainability. They should also ask how sustainable are these dividends? Can the company continue paying them in the future? Is the company keeping enough profits for its future growth? And this is where dividend cover plays a crucial role. It measures how many times a company can pay its dividend from its available profits. In simple terms, it tells investor whether the company's dividend are well covered and sustainable or at risk of being cut. Dividend cover is calculated by taking the difference of profit after tax and preference dividend in the numerator and divided by ordinary dividend paid in the denominator. In this formula, profit after tax is the total earnings available to all the shareholders. Preference dividend is the fixed payment made to the preference shareholders before paying to the ordinary shareholders. And ordinary dividends paid is the total dividend distributed to the common shareholders. If a company accounts for preference dividend as an interest expense, they are already deducted in profit after tax. So there is no need to subtract them again in this formula. Let's consider two companies, Company A and Company B, and see how dividend cover works. Let's say Company A has profit after tax of $200 million, preference dividend is $20 million, and ordinary dividend is $90 million. Dividend cover would be calculated as 200 minus 20 divided by $90. Company's A dividend cover is 2 times, meaning it earns twice the amount needed to pay its ordinary dividends. This suggests dividend security and profit retention for growth. Let's say Company B has profit after tax of $120 million. Preference dividend is $10 million and ordinary dividend is $90 million. Dividend cover would be calculated as $120 million minus $10 million divided by $90 million. Company's B dividend cover is 1.22 times, meaning almost all of its earnings are paid as dividend, leaving little amount for reinvestment. This might be unsustainable if the profit decline. A ratio of 2 is ideal. This means that the company pays 50% of earning as dividend and reinvests 50% for growth. My friends, dividend cover for shareholder is similar to interest cover for lender. Dividend cover measures how secure dividend payments are for the shareholders, just like the interest cover measures how secure interest payments are for the lenders. The key difference is that the company must pay interest to the lenders, but dividends are discretionary. They can be cut if needed. In summary, Dividend cover is crucial for assessing the company's ability to maintain and grow dividends. A ratio of 2 is ideal, balancing dividend payments with profit reinvestment. A high dividend is great, but a sustainable dividend is better. Smart investors look for companies with a healthy dividend cover that ensures both income and growth potential. All right, my friends, we have now completed our discussion on investor ratios, covering key metrics that investors use to assess the company's profitability, market valuation, and income potential. Number one, earning per share. It helps investors evaluate the company's profitability on per share basis, making it a fundamental indicator of the financial performance. Number two, price earning ratio. It reflects market sentiment and investor confidence, helping determine whether a stock is overvalued, undervalued, or fairly priced. Number three, dividend yield. It measures the return investors receive in the form of dividends, helping income focused investors evaluate potential passive earnings. And number four, dividend cover. It is a critical metric that ensures dividend sustainability, helping investors assess whether a company can maintain or grow its dividend payment in the long run. While each of these ratios provide valuable insight, they should never be analyzed in isolation. Smart investor connects the dots, look at these ratios together alongside industry trends, economic conditions, and the company's fundamental before making the investment decisions. Always remember, investing is not just about numbers, it's about understanding the story behind the numbers. The best investors don't just look at past performance, they assess the bigger picture, anticipate trend, and make informed decisions based on both financial data and strategic business insights. So, my friends, whenever you analyze an investor ratio, don't just memorize the formula, analyze what it tells you about the company's future. That's all for today. Keep learning, keep analyzing, and I will see you in the next lecture.